Understanding dividends and dividend investing can make a serious change in your financial life years from now. There are a lot of people who are able to actually retire just off of their dividends, not even their appreciation of their portfolios year over year, but just the monthly payouts from these companies. So in this video, we're going to go over what a dividend actually is, why certain companies don't pay out dividends, some things to look for when it comes to dividends, and more importantly, some things to stay away from when it comes to dividend investing. So make sure you hit the like button, make sure you subscribe to this channel, comment down below your favorite dividend companies. I would love to look over them. I would love to get your feedback on what you invest in. I think that it would just be really cool to see what everybody else is doing. So first of all, what is a dividend? A dividend is essentially a portion of the profits that a company makes which they pay back to their shareholder. This is why a lot of investors such as Warren Buffett, Benjamin Graham, the godfathers of investing, love dividends, not only because they get a certain amount of money paid back to them every single quarter or every single year, but more importantly, it shows that a company is stable enough to actually give money back to its shareholders. There are some people who even want to see at least a 10, 20, or 30-year history of a dividend payout. I'm not one of those people, but if you're a very conservative investor, then it's a very good sign. Now, how come all companies don't pay a dividend? Well, first of all, some companies are not profitable. Yeah, if you haven't looked into the financials of a lot of these companies on the New York Stock Exchange, you would probably see that some of these companies are not profitable. In fact, Tesla, the huge company that it is today, was not profitable up until a couple of years ago. Amazon was not profitable, quote unquote, up until 4 or 5 years ago. A lot of these big companies that you think of or you're buying that are currently in your portfolio, they might not be profitable. So obviously, if you're not turning a profit, you're not going to be able to give some of that money back to your shareholders. Now, in the instance of Tesla now or Amazon, these companies don't pay dividends because they would rather reinvest that profit back into the company to grow the company. And I agree with that, especially if you're a big tech company. You know, maybe Amazon now could pay a dividend, but when they were getting started and over the past 10 years, really growing this company, well, I understand not giving a dividend. And even now, if I was an Amazon shareholder, I wouldn't really care too much about the dividend because look at all the amazing things that this company has done over the past 5 years, taking all of the money that they've made in profits and reinvesting most of it back into the company. I am somebody who is more of a growth investor. This means that I would rather invest in the appreciation of the company by growing at a huge amount. And in order to do this, the company has to, number one, usually be a game changer or a disruptor, or number two, have to at least as well, reinvest their profits back into the company to grow overall. Now, when a company pays a dividend, it is called a yield. A yield could be in percentages, maybe like 2 or 3% every single year, or it could be in a dollar amount, maybe $1, $2, $3, $4, $50, $100 per share. I don't think there's any companies that pay that much, but a yield will either be in a percent or it will be in a dollar amount. So knowing that companies pay dividends, saying in a yield of 5%, wouldn't you just want to buy the companies that have the highest dividend yield? Because if we're trying to make monthly income off of these dividends, why would I not just purchase the companies that are paying out the most? This is a huge problem that a lot of beginners make. They think that the bigger the dividend, the better the company, and that's not the case. A lot of the times, these huge yielding dividend companies are doing that as a way to persuade their shareholders to stay with the company. It's not uncommon to actually purchase a high yielding dividend company, and over the life of you holding it, or maybe even say 3 to 5 years of purchasing and holding the stock, you actually lose money. So for instance, one of these high yield companies would be something like BP. BP has actually in the past 5 years gone down 50%. So while you would have made 13% return on your money as far as a dividend every single year, you would have actually lost a little more than 10% every single year just holding this company. Even if we look at the past 1 year, the company is down 56% and you would have made a 13% return on your money in the form of a dividend. So obviously purchasing the highest yielding company is not always going to be the best thing. That's why you have to learn how to evaluate a company, and usually a dividend is just going to be the little icing on the top of the cake because you're not investing in a company solely for the dividend. You should be investing in the company because it's a company you love, and the dividend should just be a little extra reason for you to hold your shares within that company long term. Now, a lot of people say to me, I'm not really sure what dividend company is to purchase, and we're going to go over some things for you to look at. But before that, you can actually purchase dividend ETFs. So the same way that you could buy something like the S&P 500, the overall stock market index through something like Vanguard, you can buy an overall high-yielding dividend ETF. And side note, if you don't know what an ETF is, it just means an exchange-traded fund, and kind of think of it like a folder. So instead of just owning one stock or one company, you can own a folder or an ETF which owns hundreds of these different companies. And one of the bigger, more popular dividend ETFs is SPHD. Now, the cool thing about this is that the way that the portfolio is balanced, you actually get paid a dividend every single month. I'm not a huge fan of SPHD because if you look at the main holdings within this ETF, I'm just not a fan overall of these companies by themselves. But then again, that's because I'm an active investor. I'm very specific about the investments I take, and I want to be a part of that. If you're somebody who just wants to get paid a high amount of dividends every single month and you want to hold these companies for a long time, something like SPHD could be really great for you. However, let's say that you're a more active investor and you still want to get paid monthly dividends, you could just do something like buy Pepsi, Lowe's, and J&J and actually get paid every single month. For me, I would rather handpick the companies that I'm going to be in because I can actually do my diligence on the company, the management, where they're going, and the payout ratio, which we're going to talk about next. So a payout ratio is essentially what percent of the profits are they able to pay out to the shareholders. Obviously, a higher payout ratio is actually going to be worse because if the payout ratio, say, of Pepsi is 100%, then they cannot raise the dividend. And the reason you want to get into a company and hold on to the dividend and hold on to really your shares in the company is in hopes that the company is going to raise the dividend year over year. But if the payout ratio is 100%, then they cannot raise the dividend. So I like to find companies that have a payout ratio of at least 60% or below. The best, in my opinion, is 50 or 40% below. For instance, if we look at AT&T, this company has a payout ratio of 60%, which means that they are already paying a pretty high dividend and they have more than enough room to go ahead and raise it. So we've already gone over why companies pay dividends, why companies don't pay dividends, what high yields are, why some companies would give a higher yield out than others, and some things to really watch out for, as well as payout ratio. But what do I actually look for in a dividend company? And I will give you the best dividend company in my personal opinion, and that would be Skyworks Solutions. Now, the reason that Skyworks Solutions is my personal favorite dividend company is because they are, number one, a company that has a ton of room to grow. Now, this isn't going to be a whole deep dive on Skyworks Solutions. I can definitely do that in the future if you want me to, so comment down below. But Skyworks Solutions has a bright future with 5G really rolling out in the next 5 years. This company has the ability to grow massively, which means the company will for sure, in my opinion, of course there's always risk, appreciate pretty well over the next 5 years. As well, they have a very steady dividend and it has a very low payout ratio, which I really like, which means that they can continue to raise the dividend, or in a troubling economic time like right now, they're not going to go ahead and cut the dividend because it's not like it's maxed out and they need that money. The final reason that I love this company, I think it's one of the best dividend companies out there, is because from a financial standpoint, the balance sheet and the income statement are almost flawless. So when you're looking at a dividend company, don't just look at the dividend, look at the company. That is what's the most important. The dividend is just the cherry on top. Look for a lower payout ratio of about 60% or below. See, hopefully, that the company has had the dividend for a bit and they're consistently raising it. And as well, make sure that it's a company that fundamentally makes sense to you and that you see appreciating over time. So I want to thank you guys for watching this video. Please comment down below some of your favorite dividend companies. I'd love to look over them. I want to thank you guys for watching. Hit the like button, comment down below, subscribe to this channel for more videos like this every single day. And guys, until next time, peace.